The yarn maker bought this cotton as input, deployed workers, he deployed machines, a factory where there are workers, there are machines, there's a lot of cost involved here. So when he prices his yarn will be definitely a higher market price than the input that he has gotten. When you become an IAS officer, you will be given a house to live in. You'll be given a driver alongside a car. You possibly might also be given a security guard. Now, these are all payments which you would have paid for from your own pockets. The government is paying for those things on your behalf. Now, since the firm received a certain revenue from the sale of its output, from all the money, they have put aside some part of this money to cover for these two. You add this plus this, you will find this and this gets cancelled out. We want to negate the effect of these price changes. We only want to understand what is happening to the economy in quantity terms. Is it producing more quantity or is it producing any less quantity? Hello and good evening everyone. For those of you who don't know me, my name is Ranchan Kaul and I take Indian economy at PW Only IAS. This video is in continuation from where we left last time, which was GDP. Today we will discuss the various methods of computation of GDP. Now, in the last class, we did discuss what the meaning of GDP is, each phrase in the definition of GDP and the implications thereof. We had started off as to what could be the possible ways of estimating the value of GDP of an economy. Now, I will take you back to the circular flow of income once more. And in the circular flow of income, there are firms, there are households, there is the government, and there is the external sector. Now, the firms are in charge of production, which means any output produced by an economy in the form of goods and services will be done by entities that we call firms. Imagine that there is an economy, and in this economy, the only final good which is produced are cricket bats. The firm is going to produce these cricket bats. Let us say it has produced a total of 1,000 cricket bats. And out of these 1,000 cricket bats, the market price for each of these is rupees 100. This is the market price of cricket bats. Very simple economy. The only final good that it produces, let's say, is cricket bats. It has produced 1,000 of these. Each of these bats is priced at 100 rupees. So if I simply tell you to calculate for me what the GDP of this economy would be, what will be your answer? Take a moment. It's very simple. You will simply multiply the quantity of final goods produced with the market price, which is 100. The GDP of this economy should be 1 lakh rupees. When we go to these firms and ask of them the amount of output that they have produced and what is the market price of this output, this is going to help us calculate the value of GDP through a method which is what we call the production method, also called the output method, also called the value added method. In this method, we simply go to these firms whose task is to produce these final goods and services. We ask of them how much and we ask of them what is the price of each of these. And we arrive at the value of GDP of an economy. The other way of finding out the same value, 1 lakh rupees, is going about it but a little indirectly. Which means what? Which means that these bats which have been produced, they have been produced essentially to be sold in the market, which means some of these bats can be bought by the households. Let us say, for the sake of simplicity, 200 bats were bought by households. Let us say the government also raises a cricket team of its own and it buys 100 of these bats. This economy also exported 500 bats. Now, in terms of the production of bats, 1,000 were produced, but this economy or these firms were able to sell only 800 of these. 500 as exports, 200 to households and 100 to government. Now, if we only look at how much money was spent by others on these bats, we will arrive at government's expenditure. Government has bought 100 of these bats, so it has paid 100 times 100, which is 10,000 rupees. The expenditure of government on these bats is 10,000 rupees. Similarly, households have bought 200 bats. That means they have spent 200 times 100, which is 20,000 rupees. on these BATs. This we will call consumption expenditure, expenditure made by households on goods and services produced by firms. Similarly, the economy has also exported 500 of these BATs, which means other countries have bought 500 of these. How much money have they spent on these BATs? This will be rupees 50,000. Now, if we add up each of their expenditure, you will have 10,000 plus 20,000, 30,000 plus 50,000, 80,000. Consumption expenditure plus expenditure made by firms plus the external sector, all of them combined, the expenditure by government and that of the other firms. Consumers have spent a total of 20,000. Government has sold a total of 10,000, and export value in this case is 50,000 rupees. This comes out to be 80,000 rupees. Now, is 80,000 the GDP of the economy? Certainly not. What is missing? What is missing is that part of the output which was unsold. And this part of the output which was unsold is going to add to the stock of unsold goods which remain with the firms, something that we call inventory. That means the inventory of these firms has increased by the total number of unsold BATs, which in this case is 200. Now, since nobody else, neither the external sector, nor the households, not even the government, nobody else spent any money in buying this output, does not mean that this output was not produced. And GDP of an economy is not the market value of goods and services sold. It is the market value of final goods and services produced within this economy. These 200 BATs were produced, just that nobody else made any expenditure, nobody else bought it. Which is why the value of change in inventory, which is 200 BATs multiplied by the market price of each of these, 20,000 will also have to be included, and we will treat it as the investment expenditure made by who? Made by the firms. So now do you arrive at a value of 1 lakh rupees? Certainly yes. This is the other way of coming down to the same value. This method is called the expenditure method. In this method, we only add up the expenditure made by all the agents in an economy over a certain time frame on final goods and services purchased by them. That should also lead us to the same value of GDP. The other way of finding the same is, now imagine that if all the BATs were sold, which means this 1 lakh rupees has been received by these firms as revenues. Now, out of these 1 lakh rupees, the firm will have to pay its workers. Firms will have to pay for the capital that they borrowed. Firms will have to pay on rent also. The remaining part will accrue to the firms as profits. Imagine that the wages to the workers was 20,000 rupees. The interest paid on capital borrowed was, let's say, 10,000 rupees. The rent paid was, let's say, another 20,000 rupees, which means from this 1 lakh rupees, 20,000 plus 20,000 plus 10,000, which is a total of 50,000, has been given off as factor payments to whoever contributed the factors of production. The remaining part, 1 lakh minus 50,000, that means 50,000 is profits, and profits are also the incomes of firms. Other way of looking at the GDP of an economy is by adding up the incomes paid for the production of these final goods and services. There are three ways of looking at and calculating the value of GDP of an economy. The first method is called the output method, where you simply go to the firms and ask of them how much final goods and services did they produce and what was the market price of each of these. The other way of arriving at the same value is by adding up expenditure on these final goods and services produced within the year by others. This is called the expenditure method. And the third method is that when these goods and services were sold, the firms would have received a revenue, and revenue would have been distributed as incomes to various factors of production, including the entrepreneur. So if we add up the incomes which were distributed for the production of these goods and services, we will be able to arrive at the same value, which is 1 lakh rupees. These are the three methods. The first method, like I said, is called the output method, also called the production method, also called the value added method. What do we do in this method? In this method, we go to each productive firm in the economy and we ask of them what is the value of their output produced. Keep in mind that in this case, the output we have to factor in is only going to be final goods and services. Now, there is a fundamental problem here, which is how do we ever know that whether a good produced by a firm is the final good or not? Consider an example. Let us say that a farmer grew some cotton. This cotton was bought by a yarn maker. The yarn maker bought this cotton, converted this cotton into yarn, and his output is yarn. This yarn is then bought by a fabric maker, and the fabric maker in his factory converts this yarn into fabric. Now, this fabric is bought by an apparel maker, some person who makes, let's say, shirts, and he uses this cotton fabric to make a cotton shirt out of it. Imagine that the cotton produced by the farmer was worth ₹50 and he sold it all off to the yarn maker. The yarn maker bought this cotton as input, and in his factory, he deployed workers, he deployed machines, and he converted this cotton into yarn. Since he is deploying a factory where there are workers, there are machines, there's a lot of cost involved here, he will not be doing it for free. Quite obviously, he will also be looking for some profits. So when he prices his yarn will be definitely a higher market price than the input that he has gotten. Let's say that he sold off his yarn for 80 rupees. Now, this yarn was bought by the fabric maker. The fabric maker in his factory, where there were workers and machines and tools and implements, converted this yarn into fabric, and he sells off the fabric for 100 rupees. This fabric goes to the apparel maker, where there will be many tailors sitting in a factory enterprise. They will be converting this cotton fabric into shirts, and they sell the shirt off at 200 rupees. Now, from our perspective, it's very easy to understand that yes, in this economy, the final good produced has to be the shirt. Therefore, the economy GDP should be the same as the final good produced, which in this case should be the value of a shirt. But imagine you having to go to each of these productive enterprises and asking of them what their output was. For the farmer, his cotton is his final product. He does not know that when he has sold this cotton off, whoever bought it, is he going to use this cotton as swab in his household? Is he going to use this cotton to convert it into yarn? He does not know that. Similarly, the yarn maker who has bought this cotton will convert it into yarn. When he sells off this yarn, he does not know whether this yarn has been sold to a fabric maker or to any other person. How does he ever know? He does not know whether this yarn would have been used to produce something else or not, whether this yarn was the input for some further production or not. Similarly, a person who's making fabric, once he has made his fabric and he has sold it off, he does not know whether this fabric was bought by a person for personal use or for producing something else which he would have sold in the market. Similarly, the production may not stop here. Maybe a designer is going to come and buy this shirt and convert this shirt into a designer shirt of sorts and then sell it off at an even higher market price. There is no practical way of ascertaining where the production would have stopped. Hence, there is no practical way of knowing which of these goods is actually the final good in an economy. And we have devised a method to get over this practical possibility. This method is one where we do not even have to know whether a producer is making a final good or not. This method is what we call the value added method. In the value added method, we go to each of these productive enterprises and we ask of them what is their value addition. How do we do this? We simply have to go to each of these firms and ask of them two questions. First is, what is the value of your output? The second question is, what is your input cost? For example, when the surveyor goes to the farmer, he is only going to ask of him, how many bushels of cotton did you produce? The person is going to say 10. Then you will ask him, what was the market price of each of these? He will say 5 rupees. That means the value of his output is 50 rupees. Then the surveyor is going to ask the farmer, did you use any inputs? And if you did, what was the cost of these inputs? How much did you pay for these inputs? Imagine, for the sake of simplicity, that the farmer here used no inputs. So his input cost was, let's say, rupees 0, which means that the value addition done by the farmer is value of output minus the input cost. Rupees 50 minus rupees 0, it is 50 rupees. That means he has from nothing created something worth rupees 50. You go to the yarn maker, you also ask of him the same two questions. Firstly, you ask of him, what is the value of your output? He is going to tell you, the value of my output was 80 rupees. Then you ask him the next question, which is, what was your input cost? And he is going to mention that, yes, I had bought cotton from a farmer for rupees 50. That means the value added at his step is going to be the value of his output minus the input cost. This is going to be 30 rupees. You ask the same question from the fabric maker too. What is the value of your output? He is going to say 100 rupees. Then you ask of him, what was your input cost? Since the fabric maker has used this yarn as an input, he is going to tell you that my input cost was 80 rupees, which means that his value added will be 100 rupees minus 80 rupees. This will be 20 rupees. You go to the shirt maker, you ask of him, what is the value of your output? He is going to tell you that the value of my output is 200 rupees. The next question you ask of him is, how much did you buy the input for? And he is going to tell you that I bought the input for 100 rupees. That means the value added at his stage will be value of output minus the input cost. This would be a total of 100 rupees. Now, if you only add up the value added at each stage, 100 rupees plus 20 is 120, plus 30 is 150, plus 50 is 200, you arrive at this value. This is what is called GVA, gross value added. The method is very simple. The method presents a practical problem, which is no person will ever be able to tell which goods are final goods and which ones are intermediate goods. So to get over this problem, you don't even have to know whether the output produced by a productive enterprise was the final good or not. You only have to go and ask of them what is the value of their output, the market value of their output, and if in the production of that output they required any inputs to be bought from the market or not, and if they did, what was their input cost. You subtract the input cost from the value of output, you get the value added at the level of that productive enterprise. You do this for all the firms in an economy, what you get is called the GVA, the gross value added for the entire economy. This is the first method. The second method is the income method. Now, what is the income method? The income method is very simple, which is, this time you are going to be arriving at the value of GDP from the side of distribution, which means towards the production of final goods and services by firms, they would have distributed incomes. So you will go to each of these firms and ask of them how much incomes did you distribute through this cycle for which I am computing the GDP. This income would be distributed in the form of wages, in the form of interest payments, in the form of rent, and in the form of profits. Now, the wages could be in cash, wages could be in kind. For example, When you become an IAS officer, you will be given a house to live in. You will be given a driver alongside a car. You possibly might also be given a security guard. Now, these are all payments which you would have paid for from your own pockets. The government is paying for those things on your behalf. They are compensating you not in cash, but also in kind. Similarly, if the firm has borrowed any capital, on that capital, how much interest did they pay during this financial year? Similarly, if you have rented a certain property, right, how much was the rent that you had to pay? But if you are owning your own property, self-owned property, the value of rent shall be imputed. What does this simply mean? It simply means that consider that you have a factory, this building is of your own, so you don't have to pay any rent here. But what if this building was not your own? In which case, how much rent would you have had to pay if this building was not your own? That is called the imputed value of rent. For self-owned property, the value of rent is imputed, while for property which does not belong to you, quite obviously you will have to pay a rent there. Similarly, we are going to ask the firms how much profits did they have to distribute. Now, each of these, wages plus interest payments if any, plus profits plus rent paid, this should also total to the GDP of an economy. This method is called the income method. The third method is what is called the expenditure method. What is the expenditure method? Now, in the expenditure method, we arrive at the value of GDP by totaling the expenditure made by all agents in an economy over the final goods and services produced during a given year. Now, this expenditure can come from one or all four of the given agents. The expenditure can come from the side of households. The expenditure can also come from the side of firms in an economy, from the government, and from the external sector. The expenditure made by the households, we will call this consumption expenditure, because typically households will buy consumer goods and services. The money that they spend on it, we will call it consumption expenditure, denoted by C. Similarly, the firms, the expenditure that the firms make, we call this expenditure investment expenditure, sometimes simply investments. This will be denoted by I. The expenditure that the government makes, we call it government's consumption expenditure. This will be denoted by G. And the expenditure that the rest of the world has made on output produced by you, this is going to be called exports. Now, when we are going and surveying households, firms, the government and the external sector, asking of them how much money has been spent on final goods and services produced by this economy over a certain accounting period. Now, in the expenditure of the households, some expenditure may have been made on goods and services produced elsewhere. Since GDP is a residential concept, it only includes the value of goods and services produced within the domestic territory. We will have to exclude any expenditure made on imports. Therefore, from the value of C, we will have to deduct expenditure made by the households on imports. CM is the expenditure or that part of the consumption expenditure which goes towards imports. For example, you may have imported a perfume from UK. Now, that is also a part of your total expenditure, but because we are trying to calculate the GDP of an economy, which is strictly about final goods and services produced within the territory, this value of perfume should not be there. Hence, we will have to subtract it from your total expenditure. Same is the case with firms. Firms have imported some capital goods from the rest of the world, not have spent all their money on capital goods produced within the territory, in which case we will have to subtract the value which has been spent on imports. Same thing in the context of government also, which means the government may also have spent some money on imports. We will have to deduct that amount. Exports will be denoted by X. Now in this case, the GDP of the economy should be very simply put C minus CM plus I minus IM plus G minus GM plus X. Now you can write this down as C plus I plus G plus X minus CM plus IM plus GM. This is the expenditure made by the economy on import of final goods and services. You can write the same thing down as C plus I plus G plus X minus M, or C plus I plus G plus N of X, where NX stands for net of exports, which means the money that you have spent on exports minus the money that you have received from exports minus the money that you have spent on imports. This is the third method of arriving at the value of GDP. Now that you have arrived at the value of GDP, remember this very clearly. The value of GDP in essence is the market value of final goods and services produced within the domestic territory of an economy. That means we have arrived at the value of GDP at market prices. Here we have to note two things. From the value of GDP, we will have to arrive at national incomes, which is the income earned by our domestic residents, normal residents. Now, in the value of GDP, there are two things which are included but are not distributed as factor payments to the factors of production. What are those two things? One thing is called depreciation. The other thing is called indirect taxes. Mind you, in the market price, there may be a component called depreciation, there may be a component called indirect taxes. Both of them are included in the market price, but none of them is distributed amongst the factors of production. Since this is not distributed amongst the factors of production, quite obviously, this cannot be a part of anybody's income. Hence, when we have to go from GDP to arrive at the value of national incomes, we will definitely have to subtract these two. Firstly, what is depreciation? Now, depreciation simply is an accounting concept. What is this accounting concept all about? Whenever a firm makes expenditure on machines, tools and implements, on capital goods per se, over the course of time, these capital goods being all physical objects which aid or assist in production without they themselves getting consumed in the process, buildings, machines, tools and implements, over the course of time are going to suffer from wear and tear. And since they are going to be suffering from wear and tear, there has to be some money which has to be spent on their maintenance and on their eventual replacement. Similarly, the same capital goods may also lose their value from any improvement in technology. Engines that you find today are much more refined, much better than engines of 10 years back or maybe 20 years back. So, over the course of time, because of wear and tear, because of continuous and repeated use, because of improvements in technology, these capital goods will gradually lose value. They will witness what is called gradual loss of value. Mind you, capital goods can also witness sudden loss of value. For instance, the factory may catch fire in which all the machines, tools and implements get decimated. That is called a sudden loss of value. We are not talking about that. We are talking about gradual loss of value happening. Why? Happening because these machines will be used continuously and they're going to be suffering from wear and tear. Similarly, there may be improvements in technology where the same machines are going to turn out far too inefficient compared to the modern ones. So eventually, they will have to be replaced also, which means through gradual wear and tear, there may be some maintenance and overhauling costs, and eventually these machines and tools and implements may have to be replaced. So what firms do is that every year, whenever they receive their revenue from the sale of their output, a part of this revenue is kept aside as provisioning. These are funds which have been kept aside to cover for what? To cover for these costs, to cover for the maintenance costs and the eventual replacement costs of these capital goods. Now, since the firm received a certain revenue from the sale of its output, from all the money, they have put aside some part of this money to cover for these two. Since this has been kept aside, that means this no person is going to get. This the firm is going to retain to cover for any gradual loss of value of its capital goods. Since this is kept aside, this is why it is not going to be distributed, not even to the owner of the firm as profits. This money is just not distributed, and since this is just not distributed, it cannot be a part of anybody's income. Depreciation is simply put provisioning or funds kept aside from the revenue of a firm to cover for gradual loss of capital, gradual loss of value of capital because of wear and tear, because of improvements in technology. Now, what part is net indirect taxes or indirect taxes? Now, there are two types here. One is called production taxes. The other one is called product taxes. Both of these are indirect taxes collected by the government from who? From these firms. Production tax is a one-time payment. For example, if you have decided to set up a factory to make cars, now because you have to buy some land, you have to convert this land towards commercial use, you will have to pay a certain registration duty, you will have to pay a certain stamp fee, depending upon the commercial use of land, residential use of land, agricultural use of land. If you are using land for commercial purposes, the registration fee, the stamp duty may be higher for that matter. Now, it's a one-time payment, which means if you have to buy a certain land, you will have to make this payment to the government. Now, whether you use that land to make a factory or not, if you make a factory there, whether you produce 1 car, 10 cars, 20 cars, 300 cars, it is immaterial. This registration duty, this stamp fee will have to be paid to the government. That is an example of a production tax. An indirect tax which is levied on a producer just because he wants to produce something, and the tax is volume independent, which means it does not matter whether you actually use that land to produce something or not, and if you did, whether you produced 1 unit of that item, 10 units of that item, 1 million units of that item, that's not going to change the quantity of taxes that you have to give to the government. Similarly, there is another indirect tax which is called a product tax. A good example of this would be the GST, Goods and Services Tax. Every time output is sold, the output has also to be levied. There is a certain tax which is levied by the government on the sale of this output also. In fact, not just on the sale, also on the production of this output, excise for that matter. Now, this tax the government collects from the firm, but the firm is going to pass on the tax burden to the eventual consumer. Now, you can imagine this with a very simple example. Consider that there was a car maker, and this car maker, let's say, bought a certain land over which he paid a certain stamp duty and a certain registration fee. For example, the stamp duty, let's say, was 1 crore rupees, registration fee was, let's say, 2 crore rupees. That means 3 crore rupees he has paid to who? To the government. This is an example of a production tax, because whether he will use his land to produce anything, and if he does, whether he produces 1 car, 2 cars, 10 cars, 1000 cars, does not matter. The registration fee and the stamp duty continue to remain the same. It's a one-time payment. Now, when this car is produced, let's say that the total cost of production of the car is 10 lakh rupees. The producer at his factory gate is able to produce this car for 10 lakh rupees. Over and above this, he is going to add his profit margin. Let's say he wants a profit of 1 lakh rupees. That means he wants to sell this car at 11 lakh rupees. But the government says every time you sell something, there is one more tax we are going to levy. This tax is going to be called, let's say, a GST. Let's say the GST is of 10%, which means the price of this car before taxes was 11 lakh rupees. A GST of 10%, this would be 10% of 11 lakh rupees. This is going to be 1.1 lakh rupees, is going to make the price of this car after taxes to be 11 lakhs plus 1.1 lakh rupees, which is going to be 12.1 lakh rupees. Now, this 1.1 lakh rupees will be collected from this car maker by the government, but the car maker is going to pass on this tax burden to the eventual customer. Quite obviously, this 1.1 lakh rupees will be built into the market price of the car. This you will have to understand. This part that the firm does not keep with itself goes to the government, but is included in the market price. You can also imagine that if the government has levied a stamp duty, a registration fee on this business, the business will also want to recover this cost. So they are also going to add these towards the market price of their produce. Now, these production taxes, these product taxes, both of them are not retained by the firm, and hence the firm cannot distribute it to the factors of production. Hence, they cannot become a part of anybody's income. Now, these two things will have to be removed from the value of GDP itself. One is depreciation, the other one is indirect taxes. If this is clear, then let us move to one more important concept, which is one that of GNP of an economy. Now, we want to arrive at the value of national income. We want to know how much do our national factors of production get paid for in return for them contributing their factors of production. Now, since GDP is a territorial concept, GDP only cares about how much was produced within the domestic territory of an economy. Did it any time ask who is producing it? Not at all. For example, in India, Honda makes cars in Rewari. Is Honda an Indian company? It's a Japanese company. But in the production, it is producing those cars in India. Hence, the market value of those cars will be a part of India's GDP. But will that be a part of India's national income? This you will have to understand. In the notion of GDP, since most economies today are open economies, that means you will find that your factors of production go and produce elsewhere. The factors of production belonging to other countries also come and produce in your territory. GDP does not care about who is producing this. It only cares about how much is being produced within our territory. Therefore, we cannot rely on GDP simply or solely for the purposes of calculating national incomes, because this should be income of our nationals. Hence, from GDP, we have to move to another important concept, which is called GNP, standing for Gross National Product, which is simply put the market value of all fine goods and services produced by the normal residents of an economy. From the purposes of taxation, we call them normal residents. For your sake of simplicity, just imagine them to be your nationals. Now, GNP is a residential concept. It cares about who is producing these goods and services. It does not care about where are they producing these goods and services. Very different from the concept of GDP. GDP cares about where is it being produced. It does not care about who is producing it. GNP, on the other hand, cares about who is producing it. We are looking out for our nationals. How much are they producing? It does not care about where are they producing it. How do we arrive at GNP? This you do. GNP of an economy is simply put GDP plus one more factor which is called net factor income from abroad. What is net factor income from abroad? This is simply put factor incomes earned by domestic residents abroad minus factor incomes earned by foreign residents domestically. This is this factor. Now let me expand this. We said we are calculating the value of GDP at market prices. This would mean that we will include the value of depreciation. We will also include indirect taxes. The rest of the part will be distributed amongst the factors of the production. This means GDP essentially should be what? It should be factor incomes earned by our residents domestically and also factor incomes earned by foreign residents domestically. Because in India, you have Indian people, Indian companies manufacturing in India. You also have foreign people, foreign companies manufacturing within India. All of this will be included in the concept of GDP at market prices. Over and above this, we are adding what is called NFIA, net factor income from abroad. That means to this value, we are adding something called factor incomes earned by our residents abroad minus factor incomes earned by foreign residents domestically. This is what NFIA is. You add this plus this, you will find this and this gets cancelled out. What you are left with is, very simply put, factor incomes earned by our residents domestically plus factor incomes earned by our residents abroad plus depreciation plus indirect taxes. This is what GNP is, and this GNP will be at market prices, since it has two components in there, depreciation and indirect taxes. Now from GNP, we have to come down to national incomes. How do we do that? We will have to only look at that part of GNP which gets distributed amongst the factors of production. That means we will have to exclude these two components. So first thing we will do is, we will remove from GNP at market prices depreciation. This is going to be called NNP at market prices. That means we will first take out depreciation. When we subtract depreciation from GNP at market prices, we are left with factor incomes of residents domestically plus factor incomes of residents abroad plus net indirect taxes. This is going to be called NNP, net national product at market prices. Now from net national product at market prices, we will remove what is called net indirect taxes, and this is going to give us NNP at factor cost. And this part, NNP at factor cost, this is what we call national incomes. Get this? From this value, we have to remove these two components. First, when you remove depreciation, gross becomes net. Since this is NNP at market prices, right, this is going to be NNP at market prices. From NNP at market prices, you remove indirect taxes. What you get is NNP at factor cost, and this is what you call national incomes. So we used a very roundabout methodology to go from GDP to national incomes. Get this? I hope this is clear. Now, in addition to now you understanding what the notion of GDP is, what is meant by GNP, what are national incomes. One more thing which has to be absolutely clear to you if you have to be a very good civil services aspirant is the concept of what we call real GDP and nominal GDP. Now, what is nominal GDP? Very simply put, nominal GDP is the value of gross domestic product GDP arrived at by factoring in the current prices. Very simply put, nominal GDP for the year 2025 is going to be the quantity of output produced in the year 2025 multiplied by the prices of that output in the year 2025. This is called nominal GDP, which means we are arriving at the value of GDP at the current prices. What is real GDP? Real GDP is the value of GDP arrived at by factoring what we call base year prices. For example, the current base year is 2011-12. This may change very soon. It has been in the news, right? When you have to arrive at real GDP for the year 2025, you will include the quantities of 2025 multiplied by the prices of those quantities, those commodities in the base year. Now, why do we have to have these two things separately? Imagine that there is an economy, and in this economy, let's say the output produced is shirts and pants. In 2025, the economy produced 100 shirts and 100 pants. Each shirt was produced or was sold at a market price of 10 rupees. Each pant was sold at a market price of 20 rupees. These are prices in 2025, which means that the nominal GDP for 2025 will be 100 multiplied by 10, which is 1000, plus 100 multiplied by 20, which is 2000. Nominal GDP for 2025 would be 3000 rupees. This is the nominal GDP for 2025. Now consider this economy was hit by a war event. Many of the factories were destroyed. In 2026, because of the destruction of many of its factories, the quantity produced by the economy reduced to half, 50 shirts and 50 pants. Now you can imagine if the availability of goods and services gets reduced while the demand stays the same, typically the prices are going to go up. Let us say each of these shirts was now sold for 20 rupees and each of these pants was now sold for 40 rupees, which means that the nominal GDP of the economy will be quantity multiplied by the current prices, 50 multiplied by 20, which is 1000, plus 50 multiplied by 40, which is 2000. The nominal GDP is going to be 3000. Now imagine a major leader came in and the major leader said that we have to recover this entire economy, we have to build back these factories. And let's say in 2027, this leader succeeds and he creates a huge productive capacity of the economy. And now we are producing 200 shirts and 200 pants. Since the supply has increased, typically should have a declining effect on the prices. Now let's say each shirt is being priced at rupees 5, each pant is being priced at rupees 10, which means that the nominal GDP of the economy should be 200 multiplied by 5, 1000, plus 200 multiplied by 10, 2000. It should be once again 3000 rupees. Now imagine some person tells you that there is an economy. This economy's GDP has remained 3000 rupees in 2025. It was still 3000 rupees in 26. Again is 3000 rupees in 2027. What would you believe? What has happened to the economy? You will think that nothing in this economy has changed. That is the impression that nominal GDP may create on you. you may think that this economy fundamentally changed absolutely nothing. But in reality, what you're witnessing is that this economy's productive capacity was reduced to half from 2025 to 2026. And from 26 to 27, the economy's productive capacity boomed 4 times. In reality, a lot has changed during this time frame, just that the nominal GDP is not reflecting that. Why? Because nominal GDP can change because of 2 reasons. It can change because of changes in quantity. It can change because of changes in prices. Now, prices change all the time. Quantities may change all the time. We are interested in knowing only and only how much has changed in quantity terms. We are only interested in knowing what is happening to the economy in volumetric terms. What has happened to its volume of output produced? Has it increased? Has it decreased? That we can do by negating the effect of this price rise or price decline. Because market prices can change anytime. We want to negate the effect of these price changes. We only want to understand what is happening to the economy in quantity terms. Is it producing more quantity or is it producing any less quantity? How do we do that? We hold these prices constant. We select a year which is called a base year. And for every year, we calculate its real GDP at base year's prices. For every year, we calculate its nominal GDP. We also calculate for the same year its real GDP. Nominal GDP is calculated at the current prices. Real GDP is calculated at base year prices. Now, imagine that the base year selected by the economy was 2011-12, and in the base year, one shirt was priced at 2 rupees, one pant was priced at 4 rupees. Imagine that this was the prices of the output in 2011-2012. Now, for each of these years, calculate the real GDP. Real GDP will be quantities of the current year multiplied with the prices of the base year, which means 100 times 2, 200, plus 100 times 4, which is 400. Real GDP for the economy should be 600 in 2025. In 2026, real GDP should be quantity of 26 multiplied by the price of the base year. 50 multiplied by 2, this is going to be 100, plus 50 multiplied by 4, this is going to be 200. The real GDP has dropped to 300. Now for 2027, calculate the real GDP. 200 multiplied by 2, this is going to be 400, plus 200 multiplied by 4, this is going to be 800. The real GDP for the year 2027 is 1200. Now draw a comparison. The real GDP from 2025 to 2026 reduced to half. What had caused this reduction? A decline in the volume of output. The output produced had halved. That caused the reduction in real GDP of an economy. From 26 to 27, real GDP has increased 4 times. Why? Because the volume produced has increased 4 times. The quantity of output produced has increased 4 times. This is the real reflection of what is happening to the economy in output terms. And this is the reason why economic growth is simply defined as an increase in real GDP. Every time you hear the growth numbers of an economy, this growth will be coming from real GDP numbers. Economic growth is a reference to the volume of output produced by an economy. Economic growth is simply an increase in the volume of output produced by an economy, also defined as the increase in the real GDP of an economy. This is the notion of real and nominal GDP. For every year, we calculate both. We calculate the nominal GDP, we also calculate the real GDP. Normally, every time you hear the word that India wants to become a $5 trillion economy by 25, we want to become a $10 trillion economy by 27, that is the reference to nominal GDP. But every time you find in the news that Indian economy's growth has increased to 6%, that growth number is coming from real GDP, not from nominal GDP. Because growth is simply put what is happening to the volume of output produced by an economy. If that is increasing, that is when we say that the economy is growing. With that said, the discussion on national income, gross domestic product is over. For you, I will request you all to please read up the limitations of GDP as a concept. What is it that the GDP tells? What is it that the GDP hides? If you get a question asked around the limitations of GDP, you have to point out to the shortcomings of the notion of GDP. What does it not really include? That part is something for you to read. In the next class, we will discuss money, money supply, and central banking. Thank you. I'll meet you again.